Welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral. We have with us Mr. Ashwin Parekh, Managing Partner at Ashwin Parekh Advisory Services LLP, joining in. Welcome to the show, Mr. Parekh, and always a pleasure to speak to you and get insights from you in this space. I'm sure you will know that my first question is going to be with regards to this merger that we've seen between HDFC and HTFC Bank. What are your views?
Well, I mean, there are several thoughts that, can cross our minds. But one thing pretty clear, basically, the whole argument which started almost about 15 years ago on the regulatory arbitrages between NBFC and banks. And you had almost, the subject of sort of how much of, let's say, regulatory leeway does an NBFC get, and how much of sort of the sort of oversight that it gets from the regulator. It's been almost like a yo-yo, if you asked me honestly. I've been observing the industry for the last 15 years. So during one regime, under people like Mrs. Usha Thorat and the others, we said, okay, let's go a little difficult on NBFCs because they borrow from the public. They borrow public funds in a big way, and then they pose systemic issues. To another swing we thought we saw in 2014-15, when suddenly we said that, okay, NBFCs are here to stay and they play an important role in the economy. And then in 2018, we started refining those thoughts when RBI clarified, that only about, the first 10 of the NBFCs or 12 of the NBFCs account for 75% of the total systemic risk or total NBFC balance sheets. And then we had the internal working group of RBI talking about transition of NBFCs into banks. Something remarkable has happened during this last 4 years. Ever since the universal bank application has become on tap, kind of, something very interesting has happened. I think regulator also has played a very significant role in taking away the arbitrages. So, is it really a good fun to be an NBFC any longer? Are you enjoying any particular advantage over a bank in terms of extent of regulatory overhang, or let's say oversight, or your SLR and other requirements? So gradually those differences have sort of, been taken away. In which case, if you are a large NBFC, then you are almost subject to the same amount of regulatory kind of oversight, which a large bank would or a mid-sized bank would be. So to that extent, then the question of whether you should continue as an NBFC or you should. Then here there's something else that happens, also in the last 3-4 years. See, I think banking credit, to NBFCs is also sort of is becoming a bit tighter. And the price at which, let's say, they offer that credit also is becoming a little tight, a little expensive for the NBFCs. So these factors gradually narrowed down the amount of cost you paid to transit from one structure to the other, from NBFC to banking. It reduced the cost, and the benefits were always there. The cost of funds being one of the major benefits, for instance. So this merge that you referred to has something to do with that. They themselves have explained it. There may be one or two other factors, perhaps. If you look at the age of senior management at HDFC, for example, then Keki, Renu, and the others, for example, then Mr. Mistry and Ms. Kannad. So you really start realizing that the so-called sort of a way to now take the organization forward for as a distinct separate entity, for example, or the benefit of giving away to a younger generation kind of leader like Shashi. That also would have played in the minds of the boards of both these institutions, both these organizations. So all said and done, I would say a very interesting announcement yesterday.
Right.
Now,
so, as you're mentioning, Mr. Parekh, that yes, an interesting landscape. How do you think will it change the overall landscape of the Indian banking system?
So that's also a very interesting analysis. You see, let's look at what the Indian banking is today. Now, you will agree with me that, you have, on top of the entire sort of structure, State Bank of India, SBI, and then we had sort of ICICI thereafter. And then we had sort of other banks. HDFC was somewhere there, fourth or fifth. Now, Now what is happening is with this merger, the whole landscape changes. I mean, the private sector banking, the size of private sector banking is much more compared to, let's say, the public sector banking now. So if I were to look at the total assets under private sector banking balance sheets and under public sector bank balance sheets, then of course the merger in the public sector banks also played a part. I mean, for last 2 or 3 years, they were totally engaged. Their minds were totally engaged. The management bandwidth was engaged with that. In the process, they've not been able to grow their balance sheets also. I would make 1 or 2 exceptions. I mean, Bank of Baroda could be an exception, for instance. And then we'll have to see how Punjab National Bank pans out of this entire sort of, new challenge that it has. But and there's a big but out here. Pandemic has made a big difference here. What pandemic has done is, I think SBI, ICICI, HDFC, these are NXS, I mean, these organizations now sort of, change the whole method of banking in a different manner altogether. I mean, all the 3 areas, product development, you find totally new digital products now coming up from all these sort of progressive banks coming in. In that backdrop, where will HDFC find itself? In the merged entity will find itself. Now, we know all along that, let's say, when it came to credit cards, HDFC had taken a leadership role. When it came to payments, HDFC had taken, HDFC Bank had taken, a leadership role. I mean, if you take those ingredients and put them together, then you do find that, let's say, the new management will get a tremendous opportunity in using this. I mean, the kind of adaptation or the kind of acceptance of technology that they have done, the acceptance of technology that they have done. I mean, the new management will certainly find it more interesting to transform this organization and make it into something much bigger, basically. So to that extent, the whole landscape changes. Will there be room for the other banks, smaller banks, small finance banks? I suppose banking is an open game. I mean, if you are more innovative, very agile, then you can always come out. But let's be honest, the strength of a bank lies in the size of its balance sheet here. You can meet with cyclical sort of downturns, upturns very well with a larger balance sheet. You have a diversified balance sheet. So to that extent, the cyclical challenges that some sectors face, you can always sort of, focus on the others during that period. So it's an interesting landscape, I mean. But I have maintained that this decade belongs to private sector banking, and this particular merger, puts a much more larger weightage on the private sector banking now, in fact.
Right. And overall, how do you think that the transition from an NBFC to a bank actually pan out? And how do you think should an investor, actually react to it? Because yes, there will be that gap between the transition phase to what the investors are actually wanting to see.
See, the transition is going to be the most sort of, interesting part or the challenging part in this entire piece. So there are about 5 or 6 things that you do in this transition program, major things. One, of course, is you to transit the balance sheet. Now, which means you have challenges arising out of assets and liability profile of NBFC, which has to eventually become a part of the bank's balance sheet. So now when we take a look at liability, for example, an NBFC will have a very different kind of liability profile. You have deposits in case of HDFC. These deposits are mobilized at a higher rate. You are almost about between 150 to about 250 basis points of difference between, let's say, the bank deposits and NBFC deposits. So now gradually you'll have to transit into low cost kind of deposit environment, let's say. What will it do to a lot of deposit holders of HDFC Limited? I mean, particularly the senior sort of, citizens and pensioners who were expecting a certain order of, and for them, it was a darling investment. I mean, I can share this because, I mean, if you got something like 7.5%, 8%, when the bank, let's say, saving account gives you 4.5 or something of that sort, then you're certainly sort of, looking at it more seriously as with a fixed amount of wealth that you possess. they'll have to change. The merged entity will have to change that profile. So liability is one issue. You had institutional deposits like trust organizations and all in HDFC Limited, which will also now will have to transit into the bank for, So those are the challenges on the liability side. You have, let's say, long-term, let's say, bond paper that you have, and long-term, let's say, debt papers that you have floated. Now that also, when it will come up for redemption, will have to be converted into bank deposits, let's say, eventually. So that's the liability side. The asset side, we know of a housing finance company is a fairly skewed kind of a balance sheet, let's say. From there, you're transiting into a diversified balance sheet of a bank with presence in not just, retail, private sector lending, large corporates, mid-sized corporates. So that transition really is the balance sheet transition. Then the second transition is the transition of people. You have staff, which is, so far, really gained a leadership role in the real estate finance and the mortgage finance, business so far. For them to get themselves reskilled, reoriented into a bank kind of a thing is one set of transition sort of, program or challenge that, let's say, the merged entity will have to really undergo. Then there is technology transition. The technology used by these two institutions will be very different, compared to each other. And the last, but not the least, even the customers, they will change, because the profile of a bank borrower and a profile of a mortgage finance kind of let's say, organization's borrower is very different. So that also will undergo a major change. So transition, therefore, from an NBFC to a bank, if it is well organized, and you have milestones well laid out, then I suppose it can be an interesting journey, but it can be painful as well, sort of, So that's the challenge of the transition, basically.
Right. And overall, how big an impact will it be to the smaller sized banks? Because clearly, once interest rates start moving, there is going to be a fight for deposits. So do you think, for smaller banks to garner a market share for deposits is going to become really difficult?
You see, basically that difficulty was even there even before this merger. Now somehow or the other, the smaller banks show their strength by their ability to understand the economic activity of different communities that they serve here. Now, if you find, for example, that a mid-sized bank or a small finance bank for that matter, it has gone out and acquired communities, and it understands, it works closely with the communities and understands the economic sort of, working of that community and the ups and downs that they face. For example, mid-sized and small-sized borrowers would have faced a lot of difficulty during COVID period, for example, let's say. Now, if you have a small finance bank that will perhaps understand that much better, because it's also working at that community level, that regional level or that local level. For a small bank, for a large bank, that's not the story. It's a different kind of an approach altogether. So there is a good coexistence for everybody, as long as the small finance banks or small banks, medium-sized banks, private sector, public sector, if they keep their customers, they keep their service levels, in keeping with the expectations, then they could do very well. Challenge certainly is a big one, because during the COVID period also, we would have seen that those banks who were agile, up and running, who could keep their branches open, despite the fact that so many, employees of the bank may not have showed up on a given day or on a given period. But let's say they were keeping the branches always working. That made the difference. You saw that, in fact, in the last 2 or 3 years. Now, that digital story is here to stay. We're talking about hybrid model, but in banking, I don't think it's going to be much of a hybrid. Irrespective of where the employees work from, that's now becoming a little insignificant, and it's becoming not important. But how well the disruption in digital sort of, deposit gathering, digital loan giving, digital servicing, all that will play a larger role in the new context. So to answer the question, there's a good coexistence. Everybody can really work well, as long as he's agile, as long as he's innovative, then things should work out.
Right. So that's the whole story with regards to the merger. My very last question coming to you is a key concern that everyone's looking at is how the credit growth is going to pan out for the banking system as a whole. The expectation is, yes, that it could be double digits, but do you think it's going to be easy enough for the banks to garner double-digit credit growth from here on?
Well, yes. I mean, there are different forces which will really help the banking system in doing that. Let's look at the first major force. Let's look at the government itself, the policymakers. Now, policymakers, I mean, in the last two budgets, and particularly the last one, have created a very conducive sort of economic environment for the banking system to play. I mean, with a 9 lakh crore of additional sort of, outlay on asset building in the nation. And the policymakers expect that a similar number or even a number larger than that, will be really invested by the private sector in asset building and in infrastructure asset building. Now, if that were to happen, and if the economic uptake, which is already there in the last few quarters, we've seen that the economic performance has really been doing very well. If that continues, then the credit flow will grow. I'm very clear. Because what happens is, the whole problem of NPAs and quality of balance sheet comes up only during the times when the economic conditions are not conducive. I mean, we saw that right from 2012 till almost about 2019. We saw a period where there was overcapacity in most sectors. There was, the economy was gradually shrinking. And of course, pandemic changed the whole thing. But we suddenly realized that the banking sort of intermediation had actually reduced. Deposit taking had reduced. Credit outflow had reduced. NBFCs were playing larger role in the credit outflow. In fact, though they were borrowing from the banks and the public, fund system. But despite that, those equations are changing. Large size NBFCs will also want now to transit into kind of banking structure. And therefore, the credit flow now, once again, to my mind, to really participate in this economic growth will come from banking. That to my mind is very clear. On a quarter to quarter, you will find more intermediation coming up from banking, basically. Because the banking companies will also find good borrowers, and therefore, it changes the whole perspective. The mood or the mindset changes thereafter. So that is one major factor, the government. Then the second factor for credit growth, and that's the private sector. If you really look at the corporate performance, private sector corporate performance in the last 2 years, they've actually done very well. We may say, particularly the large and the medium corporate. Small corporates have suffered. The small SME sector has suffered during COVID, certainly. But the mid-corp and the large corp, private sector has really done well. Quarter on quarter, they have been showing good performance, improved performance. So from that perspective also, for the banking system to get good borrowers, it's not as much of a challenge today as it was some, let's say, 6 quarters ago or 8 quarters ago. So to that extent, I would expect a certain order of flow of, And then the last piece is the monetary policy. People may say, a lot about, the way the central bank has taken pro-growth kind of an approach. Some may not, say that with kind words. I personally find that the support that, let's say, the monetary policy has provided to the economic growth and the economic growth story of the government, cannot just be played at all. It's a big contribution. It's a remarkable contribution. And that also will assist the banking company, to answer your question, to assist the banking companies in growing their credit. The policy is still accommodative. We may find some amount of hardening of rates as we go along, but at least we suspect, this particular quarter, we may not find any dramatic change in that structure, basically. So, all said and done, these are very conducive factors. People say a lot will depend on monsoon, but irrespective of that, the agriculture sector performance has been quite good, in fact, in the last 2 years. So I would certainly say that the economic conditions are very conducive for banking and particularly private sector banking. In the midst of all this, where are public sector banking? I'm not talking about this merger, I'm talking about the banking. Where is the public sector banking in the midst of all this? I'm still finding it a little lost, quite honestly. With the exception of one or two large banks who have come out of that merger kind of sort of challenges and now become more functional, the rest are still struggling, quite honestly. So I still maintain that the next decade is going to be the decade of private sector banking.
Absolutely. It looks like a good growth story from your on as well. Thank you, Mr. Parikh, so much for joining us on the show. Always a pleasure to speak to you, get insights. Thank you. Stay safe and speak to you soon again.
Thank you, Hina. Thank you so much.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.